Dividend growth investors, bonjour, this is Mike Yahoo, founder of Dividend Stocks and passionate investor. Today we're going to talk about gold. I've been busy for the past 2 weeks. I didn't shoot any video because I was on vacation, chilling, doing some hiking and cycling. And then I come back, didn't look at the market very much, and to my surprise, gold has hit a all-time high price. So slightly over $1,900, which is pretty much. And today we're going to talk about price of gold, and also we're going to talk about whether or not you should put some money into gold. So strictly speaking, gold has always been seen as a protection against the stock market crashes. So if you look at pretty much all stock market crashes, this one, 2018, that was a flash crash, the financial crisis, the tech bubble, Black Monday back in 1987, pretty much all time where the confidence into the stock market is gone, gold price surges, which is kind of like building this perception that if you invest in gold, you protect your portfolio, which looks kind of cool, right? But in fact, it's more about a bet on fear than anything else. Gold is not a creator of value. Gold doesn't produce any cash flow, doesn't make any profit. Actually, gold is pretty much nothing but yellow metal, right? So picture this example for fun. In my pocket, I do have iPhone 6, obviously not brand new. That was launched in 2014. Back then, price for the iPhone 6 was $650. So imagine that this iPhone, instead of being a piece of marvelous technology, is just an ounce of gold. So I put it on my desk like this, and I wait. I wait until 2020. So between 2014 and 2020, I look at my iPhone, a gold iPhone, and I look at it and I wait for it to generate anything, a dividend, interest, profit, nothing. Nothing comes out of the iPhone. It's just like a big piece of metal. And in 2020, I look at it and I'm like, at least I made some money. So, you know, back in 2014, if you would buy an ounce of gold, you would pay roughly $1,250. That would be roughly the price for an ounce of gold. So today at $1,950, you're making a decent profit. That looks good. Instead of investing in an ounce of gold, if you go back into September 2014, the Apple share price was roughly $100. So imagine that today it's trading, we're in July 2020, it's trading close to $400. You don't have to do the math here. Obviously, investing in Apple was a wise decision. Obviously, you're going to tell me, well, Mike, you're cherry picking your time and you're cherry picking your stock. Obviously, investing in Apple in pretty much the past 20 years has been a better investment than gold. All right, fair enough. But keep in mind that the primary goal of gold, very hard to say, is to protect your portfolio. Back in 2014, if you just Google 2014 market crash or 2014 market overvalue, you will find articles from Business Insider, Forbes, Motley Fools. You're going to see analyst reports from Value Insider or Goldman Sachs telling you that the stock market back in 2014 was overvalued by 20, 30, even 40%. In other words, if you think that the market is overvalued by 30% at least, it would make sense that you want to protect some of your portfolio, right? And it would have made sense to invest in gold. Obviously, it was the wrong decision because there was no crash. The crash happened, a flash one in 2018 and another one right now in 2020. And even then, we kind of like recovered fully from that crash. I'm not saying that the COVID-19 pandemic is over, far from it, but so far, so good. We haven't lost a penny if you have stayed invested in your portfolio and it was well diversified. So the goal of protection was not exactly a good one. And when you think about it, why do you need protection anyway? You need protection for two things, right? The first scenario is you want to prevent yourself from panicking when the market crashes. Short-term fluctuation tend to make investors stupid. We make dumb decisions because we're in panic mode and we think that the world is going to collapse, so we want to sell everything. And if you have some protection in your portfolio, meaning that you have a protection against fluctuation, not necessarily about loss of value, well, at least you minimize the fluctuation, you don't panic, and you don't make stupid decisions because you are temporarily losing money. If you're looking for such protection, you're probably better off with bonds or by investing into real assets like infrastructures, toll bridge, toll roads, stuff like that, or even options. At least those assets are generating money. So either dividend, either interest or capital gain, but at least you get something out of it. If you invest in bonds, you'll get your interest, and at one point you'll get your capital back. Unless, and that brings me to my second point of a second reason of protection, is you believe the system is going to collapse. In that event, your bonds will worth nothing, right? You believe that the US dollar is going to go bust because the Fed is printing too much money. You believe that the Canadian economy is going to zero because we took on too much debt to compensate for COVID-19, and then the oil is not going back up. So basically, Canada is doomed. And then you believe that the euro will collapse because weaker countries such as Spain, Italy, and Greece won't be able to make it due to the pandemic, and then the euro dollar will go down as well. So if everything goes down, the only thing remaining in this gloom and doom scenario is gold. So if you think that you'll need an ounce of gold to go to the grocery store and buy a loaf of bread, well, maybe you're better off with a shotgun and a good dog, because I don't think that if the economy collapses and North America doesn't exist anymore in terms of economic power, I don't think we're going to have an economy at all. So I don't think that gold will help you out. And if you invest in ETFs, well, it's not going to be of any use. So you would need to own physical gold. And do you really think that we're going to walk around with ounces of gold in our pockets? It sounds like a Western there, and I don't think it's going to go there. But I mean, if you think it is a possibility, then you might want to invest in gold. Now back to the price of gold right now, and the fact that it's a bad protector of value. So all-time high, made a bunch of first pages everywhere, everybody's excited, and we see the trend, and then we expect it to go up to, I don't know, $2,500, $3,000 an ounce. Why not? But keep in mind that if you were late to the party back in 1980, the price there was roughly $1,900 an ounce. But if you count inflation, gold needs to reach $2,700 today with today's price money to be equivalent to the price of gold 40 years ago. So basically, if you invested in 40 years ago into gold, you hasn't made a single dollar yet. And if you look at the historical price from the past 100 years, you're going to see that it goes up and down like there's no tomorrow. It's highly volatile. Actually, if you run the stats, you'll notice that it's even more volatile than the market. It just doesn't react the same way. And all that because gold has no expectation of generating any cash flow, any profit, or any value whatsoever. It's just pure speculation. And this is why gold is high right now, because people are making a bet on fear. They're making a bet that the economy is going to crumble and that Fed is going to have a problem, and central banks around the world are going to have problems. And this is why the price of gold is high. So I don't think it is a really good way to protect yourself. I mean, I know you're going to bring back the gold surge back in the 70s, but unless you're super lucky and you're able to quickly buy and sell, or you bought gold in the 70s and then you made a fortune during that time, during that decade, if you invested in gold between 1934 and 1970, you didn't make any money. And then if you invested in gold between 1980, which was 40 years ago, and today, you haven't made a single penny yet. Pretty much same thing if you have been late to the party back in 2011. You're just making a few bucks right now in profit, which is good, but I mean, nothing compared to the S&P 500, nothing compared to any dividend growth strategy. So basically, the way I protect my portfolio is by investing 100% of my portfolio in equities. Most of it, roughly like 90% of it, is in dividend growers. The way I've built my portfolio is by selecting companies with strong business model, showing revenue growth, earning growth, and obviously dividend growth. I'm sharing this strategy 100% free in my DSR recession-proof portfolio workbook. So basically, this is my way to protect my portfolio. I'm sharing this. It's 30 pages PDF that you can download just by clicking the link below. You're going to download it. You're going to be asked a lot of questions in this workbook to help you out designing your investment strategy, defining what's a buy, what's a sell, how to build a buy list, and then stop suffering from paralysis by analysis and take some action. This is how I protect my portfolio. This is how many members at DSR protect their portfolio. And so far, it's working very well. Actually, it's working a lot better than gold. Obviously, it's not a guarantee that it's going to happen in the future, but so is gold. If we're late in the party right now and then fear starts to slow down and then people start to gain confidence in the economy again, let's say in 2021, well, then gold price is going to slowly decrease and then it's going to be a dead asset in your portfolio for a very long time once again. If you want to take that risk, be my guest. I'd rather stick with the dividend growth portfolio strategy. So I hope that you have enjoyed this video. If you liked it, smash the like button, subscribe to my channel, and I'm back now for at least one video a week. And until my next one, stay invested. Cheers.